Yo guys, it's Stackmode Chris here. Today we're going to be talking about what calls and what puts are in the options trading space. Let's jump straight into it. Options 101, the core concept of a contract. So the definition, right, not obligation. So what is an options contract in the first place? So an options contract gives the holder the right, but not the obligation to buy or sell an underlying asset, like 100 shares of a stock at a specified price, before a specified date. This separation of right and obligation is the fundamental difference between buying a stock directly and buying an option. So let's talk about the contract size. Standard contracts in the US represent 100 shares of the underlying security. So whatever option you purchase, you're technically purchasing 100 shares in a leveraged time asset manner. So when you buy one contract, you now control 100 shares worth. And the premium. This is the non-refundable price you pay to the seller for the right granted by the contract. And it's the maximum amount an option buyer can lose. Let's talk about the time constraint. So unlike stocks, options have a fixed expiration date. And if the option isn't profitable by that date, it typically expires worthless. So calls. You're going to play calls if you think price is going to go in an upwards direction. It's the bullish tool. A call option grants the buyer the right to buy the underlying asset at the predetermined price when buyers expect the price to rise in an upwards direction. Okay. And let's talk about puts. Okay. The bearish hedge tool. A put option. Okay. So once again, a put option grants the holder the right to sell the underlying asset at a predetermined price. So put option is going to be bought if you think price is going to go in a downwards direction. Okay, if you think price is going to fall in a downwards direction, then you're going to go ahead and buy a put option. Okay, and it's important to understand the concept of leverage as well too. Options allow you to control a large block of shares. Okay, so it's 100 shares per contract. Okay, so it's a lot of leverage. Okay, it's a lot of power you're going to have to control. Okay, when you start trading options, you're going to realize that it's a lot different than Forex, futures, anything else. Okay, that's a couple of factors that come into its profitability. It's not just you get paid based off of directional buys. There's going to be time that comes into place, strike price that comes into place, etc. Stuff we're going to talk about and get into. So you pretty much purchase 100 shares for a relatively small upfront cost, which is at the premium. And this magnifies both potential gains and losses. Okay, so if you're a good trader, you can really take advantage of this leverage. But if you're someone who's not consistent, you could get punished. So let's talk about the call option. Profiting from the upside. So once again, if you think price is going to go in the upwards direction, then you would go ahead and purchase a call option. If you think price is going to go in a downwards direction, you purchase a put option. An analogy I always tell my students is call. What do you do to call? You pick up the phone. And what do you do once you're done with the phone? You put down the phone. Okay, so think of put down the phone and call, pick up the phone. So profiting from the upside. When you buy a call, you're predicting that the stock's price will move significantly above your strike price before the expiration date. So buying a call, right? Let's talk about a long call. So you pay the premium and your maximum loss is limited to that amount. And your profit potential is essentially unlimited if the stock soars. So the purpose of it, right, is speculation on a stock price increase or buying the stock cheaply if exercised. And your max loss is the contract cost. So if a stock option contract costs you $500, the max loss you could lose is $5. You can't lose any more than that. Okay, it's not leverage in that sense with margin. Whatever the contract costs is the max you can lose. It's pretty amazing. But the profit you can make is going to be unlimited. It's crazy. So the max profit is unlimited, theoretically, as the stock can rise indefinitely. So there's been times where people have turned $5K to $300,000 on certain pumps and stuff like that. Options is amazing. Okay, thank God for options. So let's talk about selling a call, right? A short call. So it's when you receive the premium up front and you're betting the stock price will stay below the current strike price. So the strike price is going to be the current price. So if you ever hear the strike price, it's the current price. So you're betting that the stock price will stay below the strike price. Okay. So the strike price is going to be the price that you think the options contract is going to be going to. Okay, typically the price that, yeah, you just want your options contract to go to. And the purpose of it is to generate income, okay, to where you can bet against significant upward movement. And as far as the max loss, right, it can be unlimited, as the stock price can rise infinitely, forcing you to buy high. And the max profit, right, it's going to be the premium received. So for example, $200. So here's a call option example. So let's say stock A is trading at $50 and you buy a $55 call. The reason why you buy a $55 call is because you think it'd go up to $55, even though it's trading at $50. If you think it's going to go up to $55, then that's going to be a contract you're going to go ahead and purchase. Okay. And so going back here, so the strike price is going to be the number that you want to buy, okay, not current price. So if stock A closes at $60, right, and you bought a $55 call contract, you'd make a lot of money. You're getting paid based off predictions. So if you think price is going to go to 70 and it's at 60, if you buy a 62 calls contract, that's in between 60 and 70. So any strike price contract in between 60 and 70, you're going to be able to purchase successfully. Okay. So if stock A closes at $54, right, and you thought it was going to go down to $50 and you bought a put option, okay, then you'd be in the negatives, okay? If you bought a 50 puts and price at 54, okay, and price hasn't hit that, you'd probably be in the red, okay? Say price at 60, you bought it at, let's say you bought it somewhere near 60, right? And then you think price is going to go down to 40. Okay. If price A goes up to 70, that's further away from 40. Okay, so your put contract would then be in the negative. Okay, so the further away of the opposite side would make your money go to the downside. Okay, so if you think it's going to go up and the price starts going down, you'd be losing. If you think the price is going to go down and the price starts going up, you'd be losing. So the put option, protecting against the downside. So buying a put is like buying insurance, and it gives you the right to sell your asset at a fixed price, limiting your losses or allowing you to profit from a price drop. So buying a put, right? Let's talk about long puts. So it's when you pay the premium for the right to sell. And this is the primary tool for betting on a drop in the underlying stock price. So you can speculate, which pretty much means you place a bet on directional bias, okay? Or you can hedge, which means you buy puts and calls whenever something's going to happen to protect a long stock position. And your max loss is going to be whatever you pay for the contract. So if you pay $300 for a puts contract, your max loss would be $300. And your max profit, okay, would be limited for a put contract, as the stock can only drop to it can only drop to 0. And there's only a few instances of that happening. But if something's profitable and really helps the economy, there's short sale restriction laws to really prevent things from tanking down to 0 like that. So keep that in mind. So selling a put, so especially when you're trading the crypto and stock market too, keep that in mind. Okay, when you're trading against a market where people are trying to buy and hold their money, expecting it to go up. So your downside trade is going to be pretty limited. So keep that in mind. So let's talk about selling a put, right? Short put. So it's when you receive the premium and you're betting that the stock price will stay above the struck price. And your risk is substantial if the stock crashes. So the purpose of this is for income generation. Okay. Or you could put on an aggressive bet on upwards or sideways movement. And your max loss can be substantial. Okay. And the max profit is going to be the premium received. And a put option example. Okay. Let's say current price is at 70. Okay. Let's say you think price is going to go down to 60. Okay. You could buy any contract in between 69 and 60 in order to try to make some profit. Okay. Now, if price goes up to 75, you'd then be in the negative profit. Okay. But if price goes down, any number between 69 and 60, you'd be in the positive profit. So decoding the details, right? The essential terminology. So let's understand four terms that they're vital to really interpret any option chain. So the strike price is the agreement price. This is the fixed price at which the option buyer has the right to buy, call, or sell put at the underlying stock. And this price is set when the contract is created. And the expiration date, it's a deadline. So every contract has an expiration date. The further you buy out, the better. We're going to talk about leaps here soon. So what a leap contract here is. So a leap contract is pretty much just a really, really, really long contract. Okay, so it's whether a couple of months or you have some years on the options contract. Typically, you want to make sure you have your options contract for at least months or years. Okay, this way you guys aren't going to be getting destroyed by what's called the Greeks. Okay, some crazy things that could destroy your profit if you don't position or do your research. So the premium, right? Let's talk about what that is first. So the premium is the market price of the option contract itself. So you're going to see options contracts in decimals. So you're going to see an option contract be like 1.70 or something like that. Okay, or you'll see like 2.10. And what you're going to do, any decimal that you see on the options contract, you're going to have to multiply it by 100. Okay, so that would equal $210. So 1.70 times 100 would equal $170. Okay, 0.75 times 100 would equal $75. Okay, so keep that in mind whenever you guys are trading options and you just see a bunch of numbers with decimals and stuff like that going on. Okay, that's what's happening. Keep that in mind. So moneyness, right? The profit status. So this refers to the immediate profitability of the option if exercised right now. And let's talk about in the money. It means the option has intrinsic value and immediate value if exercised. So for a call, stock price, or strike price. And for a put, you're going to be doing strike price over stock price. Okay. So at the money, it's when the strike price is equal or very close to the current stock price and contains only time value. And let's talk about the term out the money. It means that the option has zero intrinsic value. And for a call, right, the stock price should be less than strike price. For a put, stock price would be greater than the strike price. And these only consist of time value. And rule of thumb, out the money options are cheaper, but they have a lower probability of becoming profitable. And the money options are more expensive, but they carry less risk. Okay. So that's the reason why in the money options focuses on the stock price. Okay, especially for certain things like a call, for example. Okay. In the money option, you want to try and play or buy a strike price contract that's going to be as closest to the current price as possible. Okay, so focus more on the stock price more than you're focusing on the strike price of the times. So let's talk about Greeks. Okay, these Greeks can be absolutely crazy. Okay, these are going to be things that could destroy your profit if you don't understand them. Okay, it can really destroy your whole portfolio, destroy a lot of things you're working hard for. So let's understand them. So the Greeks are measures of the sensitivity of an option price, right, the premium, to changes in key factors like time, price, and volatility, and they're crucial for serious risk management. So let's talk about the delta, right? So the delta tells you how much the options price to change for every $1 change in the underlying stock price. It also represents the probability that the option will expire in the money. And the theta. The theta measures the decrease in the options value, right? It's the premium for every passing day. And as an options buyer, theta is your enemy. Once again, as an options buyer, theta is your enemy. As an option seller, theta is your friend as you profit from the time decay. Okay, but theta is typically a negative value. So gamma. So buying options and selling options is going to be two different things. I'm going to make a completely separate video on that. Buying options, you're wanting the direction to happen. Selling options, you're selling options to people. You're pretty much selling dreams to people. That's pretty much what selling options and selling dreams. So gamma. Gamma tells you how much the delta value changes for every dollar change and the underlying stock price. And that doesn't mean a good selling dreams too. They're pretty much betting on you to lose. Okay. And gamma is going to be the rate of acceleration of your options profitability, and it's the highest for at the money options. Okay, and it's always going to be positive for option buyers. So the vega, right? Let's talk about volatility. So Vega measures the change in the options price change for a 1% change in the expected volatility of the underlying stock. And high Vega means that the option is sensitive to market sentiment and expected price swings. So the investor's perspective. If you're buying an option, you want high positive delta, high positive Vega, and low negative theta. And if you're selling an option, right, selling dreams to people, betting on their optimistic goals, okay, or optimistic views, betting on them to lose. And if you're selling an option, you want the opposite. You're looking to profit from the time decay, okay, the theta, and you want a stable stock price for the most part. Okay, that's just what you're going to be looking for as a seller. It's going to be two different games between buying options and selling them. Okay, two different games. So some basic strategies, right? Long versus short option. All basic option trading can be broken down into two core activities: buying contracts, okay, that's for going long, or selling contracts, okay, going short. So let's talk about buying options, okay, long calls and long puts. So this is generally the starting point for beginners because the risk is defined and limited, and you pay the premium upfront. So it has defined risk. If you think price is going to go to a certain place, you buy the contract for it in the direction that you want. Calls if you think it's going to go up, puts if you think it's going to go down. So you have a defined risk when you buy options, and your maximum loss is the premium paid. You can't lose more than the cost of the contract. But due to time decay, and this is why you would pay a leap contract. So a leap contract is going to be a contract over like 3 months to a couple of years long. So any contract with months on it, years on it, that's a leap. So you won't have a high probability of loss. Okay. So in order to counter high probability of loss, make sure you guys buy time. Okay. Buy leaps. Please don't try to trade 0 DTEs and weeklies and you don't know what you're doing. So due to time decay, theta, most options expire worthless. So this is why it's important to buy certain contracts close to current stock price. Okay, focus on the stock price. And you need a fast, large move in your favor to overcome the premium cost sometimes. Okay, but if you play options like shares, where you're buying options contracts years out or months out, expecting to hold for a long time, you can outplay the system. Yes, they cost more money, but trading is not just about making money. Okay, don't just focus on the trades that are going to make you money. Focus on the trades that aren't going to lose you money. Focus on the trades that are going to preserve your money. Focus on the trades that are going to keep you safe. And options has leverage returns. If the stock moves favorably, the percentage return on your initial cash outlay, right, the premium, can be really huge. So let's talk about selling options, right? Short calls and short puts. It's when you collect the premium upfront. And this requires a much higher level of caution and often higher margin requirements. So there's going to be unlimited risk involved in between selling options. Okay. So for short calls, selling uncovered calls has theoretically unlimited risk, making extremely dangerous for beginners and a high probability of gain, right? Since most options expire worthless, depending on which ones you do, let's say price is at 60. If you sell an option that's at 75 and somebody's optimistic and they buy that, okay, then you would make money, okay, because they didn't win. So it's trading. When you make money, somebody's losing. When you're losing, somebody is making money. Okay, that's just how trading works. So since most options expire worthless, the seller has a statistical edge and profits if the options expire out the money. Now, if you're really good at the market though and eyeballing certain things, you could definitely slam buying options for sure. But the defined reward. Your maximum profit is strictly limited to the premium collected when you open the position. And a critical risk note, right? Never start by selling naked uncovered call options. This means selling a call without owning the underlying stock. If the stock unexpectedly surges, your losses can really wipe out your account really fast. Okay? And stick to just buying options until you have the advanced experience with risk management and margin to sell options if you wanted to. So options give you the right, but not the obligation to buy speculative direction. Calls give you the right to buy, and puts give you the right to sell. So remember, calls are what you purchase if you think price is going to go in an upwards direction. And you're going to buy puts if you think price is going to go in a downwards direction. And risk is defined when buying options. Okay, your max loss is going to be what you pay for it. If you pay $400 for a contract, you're going to lose $400 max. But guess what? The profit you can make is infinite. Okay? The God is great. So theta is going to be the time decay. In order to counter that, make sure you guys are buying months out. Okay, by months out, years out, and give yourself time. And shorter term options are riskier due to high theta. So even though they might be cheaper and look more intriguing, stack up, get in a Stackmode, and buy the contract that's gonna really get you to where you need to be. And practice first. Make sure you guys are paper trading. Try it out. Make sure it's what you guys like before you put in any type of real capital. All right. I want you guys to stay productive to good. Keep grinding. I'm gonna catch you guys next one. I love you. Peace.